Hello and welcome to the fourth module of this course, Financial Accounting. In this lesson, we'll be looking at income statements, and under that, we'll be looking at the revenue recognition principles and guiding standards of revenue recognition. We will also be looking at cash flow statements as well as classification of assets, liabilities, and equities. So without further ado, what is an income statement? An income statement is a financial report used by a business. It tracks the company's revenue, expenses, gains, and losses during a set period. It is also known as the profit and loss statement or the statement of revenue and expense. It provides valuable insights into a company's operations, the efficiency of its management, underperforming sectors, and its performance relative to industry peers. Now, what are revenue recognition principles? Revenue recognition is an aspect of accrual accounting that stipulates when and how businesses recognize or record their revenue. This principle requires that businesses recognize revenue when it is earned rather than when payment is received, as we have learned in previous lessons. Now, under the revenue recognition principles, revenue is recognized when it is earned. This typically occurs when goods or services have been performed or delivered. It is realizable. And this means that there is a reasonable certainty that payment will be received, which often coincides with the delivery of goods or services. Now, let us look at the guiding standards and revenue recognition. The guiding standards of revenue recognition. The Financial Accounting Standards Board, FASB, established the Accounting Standards Codification, Topic 606, Revenue from Contracts with Customers, which provides a comprehensive framework for revenue recognition. And this standard applies to all contracts with customers and outlines a 5-step process for recognizing revenue. And these are the 5 processes: identifying the contract with a customer. Number 2, identifying the performance obligations in the contract. Number 3, determine the transaction of price. Number 4, allocate the transaction price to the performance obligations. And number 5, recognize revenue when or as the entity satisfies a performance obligation. Now, let us look at the importance of revenue recognition. It's important for financial reporting. It's important for consistency because, the principle promotes consistency across company and industries that allows for comparability of financial statements, and it adheres to established revenue recognition standards that help companies comply with the accounting regulations and avoid legal issues relating to financial reporting. Now, we'll be moving on to expense recognition and matching principles. The expense recognition and matching principles are critical components of accrual accounting that help ensure that financial statements accurately reflect a company's performance over time. By recognizing the expenses in relation to the revenues they generate, companies can provide stakeholders with meaningful insight into their profitability and operational efficiency. So we'll be looking at the expense recognition principle. The expense recognition principle dictates that expenses should be recognized in the same period as the revenues they help to generate. This principle is part of the broader framework of accrual accounting, which aims to match revenues with expenses incurred to generate those revenues. There are several aspects of expense recognition principles, which include timing of expense and recognition, types of expense, accrual basis versus cash basis. Now let's look at the matching principle. The matching principle is closely related to the expense recognition principle and emphasizes that expenses should be matched with the revenues they help to generate within the same accounting period. The various aspects of matching principles there are matching revenue and expenses, and the impact they have on financial statements. Now, we'll be looking at the importance of expense recognition and matching principles. It's important because of accurate financial reporting. These principles ensure that financial statements provide a true and fair view of a company's financial performance, which is crucial for investors, creditors, and other stakeholders. Consistency and comparability. By consistently applying these principles, companies can produce financial statements that are comparable over time and across different organizations. It also helps in decision making because accurate reporting of expenses relative to revenues aids management in making informed decisions about budgeting, forecasting, and resource allocation. Now we'll be looking at cash flow statements. The cash flow statement is one of the three primary financial statements used in financial accounting. Alongside the income statement and the balance sheet, we'll be looking at the balance sheet, as well in this chapter. So the cash flow statement provides a detailed analysis of a company's cash inflows and outflows over a specific period, which is typically a quarter or a year. So what are the components of the cash flow statement? In a cash flow statement, there are three main sections, which are one, the operating activities. You also have the investing activities, and then we have the financial activities. The operating activities report the cash generated or used in the core business operations, while the investing activities, it reflects or shows the cash flow associated with the acquisition and disposal of long-term assets and investments. And the financial activities section, it shows a report. It reports the cash flows related to transactions with the company's owners and creditors. Like I said, we'll be treating the balance sheet. So what is a balance sheet? A balance sheet is one of the core financial statements used by businesses to provide a snapshot or a picture of their financial position at a specific point in time. It summarizes a company's assets, liabilities, and equity. We'll be looking at classification of assets as well. Assets are resources owned by a company that are expected to provide future economic benefits. They are generally classified into two main categories. We have the current assets, which are assets that are expected to be converted into cash or used up within 1 year. And examples include accounts receivables, cash and cash equivalents, inventory, prepaid expenses. Now we also have non-current assets, which are also known as long-term assets. These are assets that are expected to provide economic benefits over a period longer than 1 year. And examples are property, plant, and equipment, which we'll be treating in another module. Another example is intangible assets such as patents or trademarks. We also have long investments and goodwill. The next thing we'll be looking at is liabilities. So liabilities are obligations that a company owes to external parties. Like assets, they are classified into two main groups. The first one is the current liabilities, and these are obligations that are expected to be settled within 1 year. And examples include accounts payable, short-term debt, accrued expenses, unearned revenue. The second category is the long-term liabilities, which is also known as non-current liabilities. And these are obligations that are due beyond 1 year. Examples are long-term debts, for example, bonds payable, mortgages, deferred tax liabilities, pensions, obligations. Now we'll be looking at equity. Equity represents the residual interest in the asset of a company after deducting liabilities. It reflects the ownership interest in the company and can be classified into several components, which include common stock, preferred stock, retained earnings, additional paid-in capital, treasury stock. Finally, we'll be looking at the relationship between financial statements, and there are three areas in which you can view this relationship. One is in the income statement, two is in the balance sheet, three is in the cash flow statement. So the ending cash balance from the cash flow statement is reported as a current asset on the balance sheet. The cash flow statement shows how cash moved in and out of the company, affecting the cash position reflected in the balance sheet. Understanding these relationships is crucial for analyzing a company's financial health. Investors, analysts, and management can gain insight into profitability, financial position, and cash management by examining how these statements interact with one another. Thank you for watching this video. In our next lesson, we'll be learning about cash accounts and receivables. Bye for now.